Thank you for joining us. You may try, but you can't touch this. I'm almost hearing the MC Hammer song in my head. Perhaps you are as well. This story refers to a recent court ruling in the state of Florida for an individual who had a HECM, a home equity conversion mortgage, and we're going to get into all the details. But first, I want to thank Todd Woodcock for turning me on to this story earlier last week. So thank you, Todd. According to reporting from Mortgage Professional of America, a Florida appellate court has ruled that funds that are in a reverse mortgage line of credit, a HECM line of credit, are in fact protected from creditor garnishment. And this really reinforces just how powerful homestead protections can be, especially in the state of Florida. The case centered on a borrower who had access to approximately $62,000 in his available HECM line of credit, funds that the creditor attempted to reach to satisfy a judgment. And when it comes to debt collections or a garnishment order, there is no mercy. But there is in this case because the homestead rules in the state of Florida protect the homeowner from being, foreclosed on or thrown out in the street in many circumstances. And this is perhaps just one of those. This ruling was handed down on March 25th, 2026 by the 4th District Court of Appeal, and it's the first of its kind in Florida. A company called Jellum Enterprises held a judgment of about $55,000 against a business called Oceanside Automotive Services in towing. The court found that the company's sole officer, Norman Desmarais, had fraudulently moved assets around to dodge the debt and held him personally liable. But of course, that's going to encumber any personal assets that he had, and that is why they tried to garnish his personal wages and also his HECM line of credit. Writs of garnishment were served on the lender, Longbridge Financial, and the servicer, CompuLink Corp., better known as C-Link, and Capital One, where Desmarais had a bank account. The creditor's argument was straightforward. Desmarais had already used some of the reverse mortgage draws for vacations and everyday expenses, not just home repairs. That meant, in their view, the remaining funds in the line of credit had lost their homestead protection and were fair game. However, the court stepped in and said no because the homeowner, and the debtor in this case, had not requested any additional HECM line of credit withdrawals since the writ of garnishments were issued. The court said the homeowner's right to it remained contingent, and the court held that a contingency cannot be garnished. And this brings to mind countable assets, something that is a big concern when you're working with a homeowner who is seeking to keep their Medi-Cal eligibility. If they have access to a line of credit, they can pull it out, but they cannot leave those funds parked in their checking or savings account, which they have access to. But as long as it's in the line of credit, it is not a countable asset. A very similar approach that the court took here. The court also noted the federal statute behind the home equity conversion mortgage, which exists specifically to help older homeowners stay in their home by converting equity into accessible funds, saying that forcing a borrower to draw down on a HECM line of credit to pay a judgment would defeat that purpose. And interestingly, in 2013, an Oklahoma court reached the same conclusion. The court did say that once the borrower does voluntarily withdraw money from the HECM line of credit, that homestead shield can fall away, depending on what the money is used for. If the borrower pulls funds to repair or maintain the home or to buy a new one, those funds may keep their protection. In the end, this ruling gives Florida reverse mortgage lenders and also loan servicers clear direction on what happens when there is a writ of garnishment issued and they're seeking remediation through withdrawals or forcing withdrawals from a HECM line of credit. So this is good news for the borrower. Now, looking at this case in more detail, he does not appear to be without fault. He did some things that were, a little questionable, but yet his home is still protected. A non-borrowing spouse who is not listed on her husband's reverse mortgage in 2011 seek or insist on non-borrowing spouse protections after the fact. That is a question that is raised in a recent lawsuit. For that, we go to HousingWire. A Virginia widow has filed a federal lawsuit against the U.S. Department of Housing and Urban Development and 3 mortgage companies. She alleges that she was wrongly foreclosed upon and faces displacement from her longtime home following her husband's death. Janice S. Kendall Mayo and the estate of her late husband, Cleveland Mayo Sr., filed the complaint on March 23rd in the U.S. District Court for the Eastern District of Virginia. The lawsuit names HUD Secretary Scott Turner, PHH Mortgage Corp., Mortgage Asset Management, LLC, and MetLife Home Loans. That tells you just how long ago this was when we're saying MetLife, as they exited the industry some number of years ago. The HECM in question was obtained in June of 2011 after her husband was diagnosed with kidney failure. According to the lawsuit, Mayo believed that the loan would allow either of them or his wife to remain in the home after one another's death. One of the plaintiff's key arguments is that in 2011, HUD counseling did not require the non-borrowing spouse to be included in the counseling session. Thus, they claim they had no knowledge of potential displacement if her husband predeceased her. Her husband passed away in December of 2024, and the loan was called due and payable, and the home was foreclosed upon in June of 2025. And the surviving widow claims that between 2011 and 2025 that she received no communication whatsoever, alerting her to the fact that she could in fact be forced to move out of the home. The suit alleges that despite them trying to use the mortgagee option election, or MOE program, which lets a non-borrowing spouse remain in the home if the mortgage is assigned to HUD, Mortgage Asset Management refused, and PHH, as the mortgage servicer, also confirmed that refusal. The plaintiff's lawsuit also alleges that this foreclosure and the loan being called due and payable is contrary to the congressional creation of the home equity conversion mortgage. So let's check on that, shall we? Section 255 of the National Housing Act, which established the home equity conversion mortgage program in 1987, clearly addressed spousal protections, and it defined the terms elderly homeowner and homeowner to mean any homeowner who is or whose spouse is at least 62 years of age or such higher age as the Secretary may prescribe. It appears that she did not meet those criteria as established in the HECM program in the National Housing Act. But now she's seeking remediation and protections ex post facto because we did not have non-borrowing spouse protections enacted until 2014. In the final analysis, what a homeowner, or a widow in this case, believes is often just as important as to what the actual HECM loan document and regulations say, and that's why we're seeing this being brought to court. Of course, it's an unfortunate situation, but it shows you why we have non-borrowing spouse protections in place for the HECM loan. And in our last story, our industry friend and expert Dan Holtquist, co-founder of Reverse Plus, reached out to us here at HECMWorld last week and let us know that their Reverse Plus analyzer has a first-of-its-kind integration. They announced that Analyzer Pro, their illustration and sales platform, now includes integration with SmartFi's proprietary reverse mortgage programs. To date, Analyzer Pro was focused primarily or solely on the home equity conversion mortgage, so this gives them even more strategies that they can illustrate when it comes to managing housing wealth and how it is utilized in retirement and cash flow management. Analyzer Pro was built to bring clarity to what is often a complex and misunderstood part of the mortgage landscape, said Dan Holtquist, co-founder of Reverse Plus. By adding SmartFi's proprietary programs, we're giving loan officers the ability to evaluate and compare more scenarios, have more informed conversations, and ultimately serve borrowers with greater confidence, understanding, and transparency. One of the challenges our industry faces today is not just knowledge, but how that is communicated to the homeowner. Now, if you look at your standard home equity conversion mortgage packet, that is not really a sales tool. In fact, at times it can be an impediment. It doesn't really clearly explain the benefits. Reverse Plus's Analyzer Pro fills that gap, providing a wealth of illustration tools that are centered on not only helping the homeowner understand the HECM, or proprietary loan in this case, but how it can be utilized to their benefit. Proprietary reverse mortgages represent a large portion of the senior home equity lending landscape, said Kim Smith, Senior Vice President of Wholesale at SmartFi. Making our programs available within Analyzer Pro gives originators a practical hands-on way to learn our offerings and better understand how our choice proprietary loan option can uniquely meet the needs of borrowers. By the way, the SmartFi integration of their proprietary products is now available in Analyzer Pro, so be sure to go to their website and check that out, and we'll be watching for any future updates to their platform.